Hi, I'm Nikita Burdick and I'm a mortgage lender. Let's talk about divorces and mortgage financing. As if mortgage financing isn't complicated enough, divorces can complicate matters even further. I'm also a licensed attorney with actual divorce experience as it pertains to the legal industry, meaning I have completed divorces as an attorney. I'm also a CDLP, in other words, a certified divorce lending professional. I'm a perfect lender for divorcing clients because I understand not just the lending laws, but also what goes into a divorce. This puts me in a unique position above other lenders. For instance, I have written divorce decrees and temporary orders for child support and alimony, and I know what they need to say so you qualify for a home loan. Okay, so what is child support and alimony? First, on average, divorces take 6 months to 1 year to complete once the petition is served. Simply put, child support is money paid from one parent to the other for the benefit of their dependents or minor children. Alimony or spousal support is the monies that one spouse is required to pay the other due to a difference in income, for instance. Out of the two dissolution payments, child support and spousal support is far more common than spousal support. Even in the 1960s, only 25% of divorces mandated alimony, and today only 10%. Each state has their own requirements for calculating and awarding child support and spousal support. We'll look at Nevada. NRS 125B.070 identifies how child support is calculated. There's also a Nevada Family Self-Help Center that has a really good worksheet that can be used. In order to determine the amount of support, you first have to determine if there will be primary or joint custody. Primary custody means that the children reside with the parent at least 61% of the time. Joint custody means that the children reside with each parent roughly 50% of the time. There is no longer any cap on determining child support. Take a look at the chart below for percentages in Nevada. You can see on this image how to calculate the child support. All right, let's talk mortgages now. Calculating income can be very frustrating in the mortgage process for clients to understand because of all the requirements. In January of 2014, with the deployment of the qualified mortgage rules from the CFPB, these guidelines are even stronger. For instance, proof of receipt of income used to be 3 months, but now it's 6 months. You may also need to show a continuance of 3 years or 36 months of support, meaning if a child is 16 years old and support is to stop at 18, then we cannot use the income. This rule is known as the 6-36 rule, 6 months receipt and 36 months continuance. You need to make sure you have a lender on your team when contemplating divorce so these things get written in correctly for you. The 3 years continuance will differ depending on what guideline you are using. With Fannie, for instance, the 3-year continuance starts from the date of application, and with Freddie, it starts with the date of note. Next, under mortgage law, certain income can be grossed up. Grossing up refers to a procedure that takes non-taxable income and increase it to the equivalent of taxable income, thus providing the savings as qualifying income. Both Fannie and Freddie allow support that is not taxable to be grossed up by 25% under the same terms and conditions as other non-taxable income sources. Now, FHA and VA allow grossing up, but it can be more complicated. For instance, they may only allow grossing up to the applicable tax rate. For instance, it may be 15%. Next thing I want to go over for this video is an advantage for paying spouse. If the obligated spouse has less than 10 payments remaining, then the monthly debt obligation may not have to be calculated into the debt-to-income ratio as long as the payment doesn't impact the borrower's ability to pay. For instance, the borrower has plenty of reserve funds. All right, now that we went over some of the requirements under Nevada law and mortgages, let's go over some nuances. When the parties cannot agree on items like child support and alimony, then the court will issue what is called temporary orders. These orders are great from a mortgage financing standpoint because the temporary orders will start the clock on receipt of support monies for underwriting guidelines. Meaning, if Fannie Mae requires 6 months for receipt of child support because it can be used as income, then the first month's child support that is received under the temporary orders is month 1. Wait, that is not it. Once there are final orders, and if that amount is higher, then we can use the final orders amount when qualifying the borrower for income. Let's take a look at an example. Temporary orders state $1,200 a month in child support, and that was paid for 5 months prior to the final orders. The decree then says $2,000 a month. We can give the borrower $2,000 a month income once that is received just 1 month to make the 6 months. Another nuance is taxes. Child support is not deductible for the payer and not taxable to the payee. Another nuance is that no part of alimony or child support can mention, another nuance is that no part of spousal support can mention child support. So for instance, if someone is receiving $1,000 a month in spousal support, and it says for the benefit of children, so the spouse can pay for children's expenses, then we cannot use that in any way towards spousal support income. All right, so these are your little tidbits on divorces and financing. If you want to know more, subscribe to my YouTube channel and watch about law and loans. Thank you.